If you're a business owner who's finally getting ready for your big exit, I'm guessing there's a lot of nervous excitement, but at the same time, there's probably something lurking in the back of your mind, a black cloud, also known as a big tax bill waiting for you. I know how it feels. You spent years building your business. You poured everything into it. Late nights, working weekends, missing time with family and friends. You carried all the risk and responsibility on your shoulders, betting on yourself when others wouldn't. Finally, the big moment arrives. You sell your company. It's an amazing moment. You've done it. You've achieved that elusive exit. You've earned your freedom. But then, you get the call from your accountant. The IRS sent you a gift too, a tax bill. They want their share. You look at the numbers and think, wait, how is it possible that I built all this and I'm still handing this much over to the government? Between capital gains tax and net investment income tax, you owe nearly 25% to the federal government. And if you live in a high tax regime state like California or New York, they want their cut too. Altogether, the IRS, state and local governments can take as much as 40%, a massive slice of what you spent years creating. And if you don't have a plan, that could mean millions gone overnight. Here's the thing that most people don't realize. You don't have to hand that money over. There's a legal, proven way to slash that tax bill, maybe even eliminate it. And no, it's not some shady offshore trick. You can do it legally with real estate. In this video, I'm going to show you exactly how entrepreneurs like you are using real estate to shelter their capital gains when they sell their businesses, and how you can do it too. There are really just two main steps, and once you hear them, it's going to make sense. Hi, I'm Dr. Kenji Asakura, co-founder of Semi-Retired MD. I'm a doctor and serial entrepreneur. I've started and sold multiple businesses myself, so I know the emotional roller coaster of an exit, the pride, the relief, but also the sting of paying a big chunk of your blood, sweat, and tears to the government. But I've also discovered how to use real estate as a powerful tax shield. My wife Leti and I have used these strategies not only to shelter the gains from selling businesses, but also to pay zero in federal income taxes for 7 consecutive years. And we didn't shelter a 5-figure salary, we sheltered multiple 6 and 7 figures. And in this video, I'll walk you through the same strategies we use to keep millions more in our pockets. If you're planning to sell your business soon, you're going to want to pay attention. This could mean the difference between losing millions to the government or reinvesting that money to grow your wealth. Let's be real. Selling your company should be your victory lap. But here's the painful truth. Uncle Sam is like the silent partner you never invited in. He shows up at the finish line to grab a third of your payout. In a second, I'll show you how I turned this exact scenario around. But first, let's go through an example. Let's say you live in California. On a $5 million exit, you're going to be paying 37.1% in combined federal and state taxes, or around $1.9 million, leaving you with about $3.1 million. And it's so much more than just numbers on paper. That's money that could send your kids to college, seed your next business, or give you the financial freedom you spent years working so hard for. And it stings even more when you think about what it took to get there. You sacrificed family time, your health, security, you risked everything. And at the end, the government swoops in and takes a massive chunk. I've been there. I felt that gut punch. But here's the thing. It doesn't have to end that way. When Leti and I sold our first business together, we didn't know what we know now. We didn't have a large real estate portfolio in place, so we were only able to shelter around 10% of our gains. But a couple years later, with our second exit, we went from sheltering 10% to 100%. And I'll show you how that worked step by step. After my wife and I had built a portfolio of investment properties, the story was completely different. We knew how to buy properties the right way, how to force appreciation, and how to use bonus depreciation strategically. When that next exit came, we were ready and we were able to shelter all the gain. That's the difference between not having a plan and being prepared. If I could go back, I would have built my real estate portfolio earlier, so I'd already had the system in place when our first exit came. And that's exactly what I want for you. So how do you do this? It basically comes down to 2 main steps. Let's start with step 1, build and manage a real estate portfolio. This doesn't mean you have to swing a hammer or deal directly with tenants. It means either you or your spouse needs to spend enough hours working in real estate, finding deals, overseeing operations, making important decisions about your properties. The IRS calls this real estate professional status, or REPS for short. There's also a related approach with short-term rentals that can qualify too. The point is, when you're active in your real estate portfolio, you unlock the ability to use real estate to offset your business gains. Step 2 is to create paper losses to offset the gain from the sale of your business. You can use these losses to offset income as well. And let me pause here because this is really important. These aren't real losses. You're not losing money. In fact, your properties can be cash flowing and making you money. But on paper, for tax purposes, you're creating losses. One of the best ways to create paper losses is with something called depreciation. If you own a business that involves buying equipment, you're already familiar with depreciation. You can write down the value of that piece of equipment as a tax deduction. In real estate, we do the same exact thing. We write down the value of the building over 27.5 years for residential properties and 39 years for commercial properties. And with bonus depreciation, you can take a huge portion of that write-off immediately in year one. Here's the best part. Thanks to the recent passage of the One Big Beautiful Bill, 100% bonus depreciation is now permanent. So when you buy the right property and do a cost segregation study, you can generate hundreds of thousands, even millions of dollars in paper losses right away. Put those two steps together, being active in real estate and creating paper losses with bonus depreciation, and suddenly you have a tool powerful enough to offset millions of taxes from selling your business. Remember earlier when I said you don't need a shady offshore trick? This is it. Now, if you're thinking this all sounds overwhelming, running your business and also managing a real estate portfolio, let me reassure you, it's very manageable. My wife and I have done it ourselves. And here's something most business owners find reassuring. Running a real estate portfolio is actually a lot like running a business, but easier in many ways. Why? Because you don't have to come up with a new product and educate your customers about it. Your product is a rental unit and everybody already knows what you're selling. Another big benefit is that you don't have to train people how to do their jobs from scratch. Contractors, property managers, investor agents, they already know their roles and responsibilities. You're coordinating and leading, not reinventing the wheel. Now, word of caution, this only works if you buy great deals. Real estate is a business, and just like you'd never buy a bad business, you shouldn't buy a bad real estate deal just for the tax savings. The tax benefits are the same whether you buy a bad property or a great one. So why not learn how to buy great deals? That means properties that cash flow, properties you can get at a discount, and properties where you can force appreciation and build equity. When you treat real estate like a business, maximizing revenue, cutting expenses, constantly improving, you don't just shelter your taxes, you also build long-term wealth. Let me give you an example from a student of our real estate course. He had just sold his business and structured it as an installment sale. So instead of taking the entire gain all at once, he spread it out over several years. That gave him time to plan. With the first installment, he partnered with an experienced investor to buy a large multifamily property. The paper losses from that property sheltered most of his gain. For the second installment, he enrolled in our real estate course, built his own portfolio, and set himself up to shelter the rest when that money came in. He reduced his taxes, and at the same time, he created wealth that will grow for decades. The installment sale is a creative way to give yourself more time to build a tax shelter, but the real lesson is this. The earlier you start preparing, taking the time to learn how to invest in real estate the right way, the more you'll be ready for that exit when the time comes. So what should you do if you're planning to sell your business? First, start now. Don't wait until just before the sale. Start buying properties the right way, at a discount, with cash flow, and with opportunities to force appreciation. Even if your exit is 2 years away, these steps compound over time. Second, build equity. Use those properties to accumulate equity and experience. Third, work backwards. As you get closer to your exit, estimate the size of your expected exit and calculate how much real estate you'll need to shelter it. Then make adjustments to your portfolio as needed so you generate enough losses to offset the entire gain. When you sell your business, 1031 exchange those properties into larger ones. These bigger properties will create the paper losses you need to offset your gain. Fifth, leverage tax strategies like REPS and the short-term rental tax strategy and combine it with 100% bonus depreciation. When you combine these strategies, you can generate massive paper losses that can offset the gains from the sale of your business. If you want to learn about these strategies, I'll leave the links to the videos in the description below. I know what it's like to be a founder. You have your head down, your entire focus is on building your company. But if you're watching this, don't ignore your taxes. Get ahead by laying the foundation of your future tax shelter before that payout arrives. Think of it this way. Protecting your gain with real estate is like instantly increasing your sales price by 25 to 40%. That's money you get to keep, money that belongs to you, not the IRS. And if you know a friend who's selling their business soon, share this video with them. It could literally save them millions. At Semi-Retired MD, this is exactly what we help high-income earners and entrepreneurs do. We've helped doctors, lawyers, and business owners like you offset 6- and 7-figure gains, qualify for reps, and use bonus depreciation to eliminate taxes. You don't need to become a full-time investor. You just need the right strategy and the right guidance. So if you're preparing to sell your company, don't wait. Click the link below to book a free strategy call. We'll walk you through how to structure your plan, buy the right properties, and legally keep millions more of what you've built. Thanks for watching. I'm Dr. Kenji Asakura, and I'll see you in the next video.